Two of the factors that will impact yield to maturity are duration and number two, credit quality. We can list those in this sort of graph. Maturity date at the bottom, one month, 6 month, 1 year, all the way up to 30 years in this example. On the horizontal axis is credit quality, and higher credit quality as at the bottom. Treasury, AAA, AA, CCC bonds. And remember, AAA, AA, C bonds in this example come from credit rating companies, and then we place bonds in those buckets. In the middle there are listed yield to maturities for those different types of bonds. And let's just focus on first the treasuries at the bottom, and this is the yield curve. Typically what you hear when you see the market talking about the yield curve, 1 month has a 0.1% yield to maturity all the way up to 1.7% for a 30-year bond. So that is the yield curve. Yield to maturities here, you see those every day. So this happens to be the yield curve as reported by the Wall Street Journal. And here you can see 30-year bonds at the top, 1.67% yield all the way down. We're sketching here the yield to maturity curve. The other item there is credit quality, and I picked the 5-year duration there, or 5-year maturity. Here you see 0.4% for Treasury, 1.4% for AAA, 1.6% for AA, 11.1% for CCC. Let's just focus on that, and if we subtract Treasury yield from AAA, we get the credit spread. That's 1% in this case, 1.4 minus 0.4. 1% credit spread for AAA to Treasury. That is fundamentally related to risk and bearing the risk, default risk. For, at this point in time, to hold AAA bonds, we need a 1% premium to hold those for the default risk associated with AAA bonds. 1.6 to 1.4, there's additional 0.2% credit spread there, and then we go up to CCC, and you can see we need much higher yield to maturities, 11.1 to 0.4. We need a 10.7% yield spread to hold those bonds. In the general economy, those credit spreads will increase of time's uncertainty. If we see a recession or concerns about recession, those credit spreads will get wider. Also, there's a general economic impact of AAA and Treasury spreads changing. There's also an individual company impact. If we look at individual companies, all publicly traded bonds, companies, corporate, municipals, etc., are rated by various credit quality companies. If we see a downgrade, that means that company is explicitly saying the default risk has increased. In that case, you will typically see an expected yield. The yield to maturity will increase, bond price will decline, you have a capital loss. Vice versa, if you have an upgrade, it means that you're moving from lower to higher credit quality. Default risk is going down. The expected yield in that case decreases because you have less risk, and the bond price increases, so there is a capital gain there. You will often see announcements of credit quality and then a market reaction to those. Sometimes there is not a market reaction to those changes in credit quality, and it fundamentally relates to whether the market anticipated the change in credit quality being noted or whether it was a surprise. There are two of the factors: duration and credit quality.